Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome. First of all, I want to wish Ramadan Kareem to everyone celebrating the holy month. Many of you know me since we have met while I was in the GCC area. And for those who don't, my name is Mimi, and I will be your host today. On behalf of LEORON, Mr. Mike Turner, and myself, I want to thank you for joining us here. We're all caught up in a really unexpected and uncertain situation with the COVID-19, and as many disadvantages it has brought, it has also a positive influence on humanity. People are connecting more, people are helping each other now more than ever. This is why us at LEORON provided opportunities for everyone to attend some webinars and courses during these difficult times. As you already know, today's topic is corporate financial management, opportunities in COVID-19 era. The agenda has been already shared with everyone, and I believe Mr. Mike will go through it once again. At the end of the webinar, all participants will receive a certificate of attendance. Feel free to use the questions area for any questions or comments you might have on the topics throughout the session. I wish you all a pleasant and a really successful webinar. Now I leave Mike the stage to you.
Great, thank you, Mimi. So welcome to today's webinar. What I want to be going through for the next couple of hours, by 5:30 we'll finish, is basically in this COVID-19 situation we're in right now, there's a whole host of opportunities. And I think we need to bear in mind, yeah, for some, there's going to be a lot of problems, but for others, or it depends how you want to look at it, there's also going to be a lot of opportunities. So what I wanted to do is talk about a personal case I'm working on right now of how I saw an opportunity in this environment, and looking at the principles of corporate finance, some of the things that we can go through and consider as to how we want to analyze those situations. Now, as you get questions, please type them in the question box as they come to your mind. We'll aim to answer all the questions during the session, but the ones that we don't, we'll respond to later. And I'll be pausing throughout the presentation as various breaks when I'll be looking at the questions. So what I want to talk about right now is how we can negotiate out of a financial difficulty. And oftentimes, this is going to involve getting values, getting the different stakeholders, and looking at what we can do. So I want to talk about things like how to assess different alternatives, the sources of finance, and of course, how we exit and make our money. So, currently in this COVID-19 crisis, I am going to talk about a personal situation I'm working on in the United States, where I'm trying to find an opportunity to turn bad news into good news for myself and one of my friends. And I'll go through that as we get onto that. A little bit about myself. I'm a US CPA, UK Chartered Accountant, and a CFA. I've trained in over 30 countries. I work with LEORON, I work with the Chartered Accountants of Ireland, with ICAW in the US and the UK, and with NATO. So I work all around the globe. I'm quite globally experienced. In India, I have a business where I do back office work for doctors and lawyers in California. In Romania, I have a real estate business where we bought lots of these little strips of land, we glued them together, and now right next to it, they're building houses. And over there on the right is a picture of me and my business partner of the land right next to it, so we'll be building houses as well. And in one of my new businesses that's exciting me is I'm going to be doing Christmas trees with Arav. He's my best friend's son. So that's one of my exciting things that I'm going to be doing. Now, getting on to what I want to talk about in this webinar is a situation I am personally being faced with. And what happened is, in the United States, there's a type of rental arrangement where, as a landlord, when you own property, what you do is you rent it out to restaurants like Wendy's, Burger King, Kentucky Fried Chicken, etc., and you get a fixed rent for a long period of time. So one of my close friends has a number of locations in the US that are currently operating as, let's say, a Wendy's, and after the 2008, the GFC, the global financial crisis in 2008, what has happened is they were started paying rent, not the full rent. And his father at that time was in charge, and his father was afraid to push legal litigation or anything because some rent is better than nothing. Now that my friend's taken over, what we're trying to look at is, well, these are locations, and because we're the landlord, we have the sales data. And we know that these locations have strong revenue. So my argument and what we're looking at doing is, why don't we enforce through the court action to get the full rent we're entitled to? When the lease is up in a couple of years, they'll move out. And I'm currently in negotiations with alternative brands, so I can take an existing location, and it's not the same amount of cost to do it from scratch to convert it from, say, a Wendy's to a Burger King. So when you have these kind of opportunities that present to you, what we need to do is analyze the numbers, analyze the risk, say, does it make sense, and do we want to proceed? So there are a lot of issues there because, you know, one of the things to get a franchise with the Wendy's, a Burger King, is they require a certain amount of assets. So you've got to present to them that you have a pretty strong balance sheet. There are other franchises like McDonald's. Now, the problem with McDonald's, from my point of view, is that McDonald's doesn't allow you to own the land. I mean, most people ask, what is the business of McDonald's? There's a movie called The Founder, and McDonald's business is actually real estate. They're the largest property company in the world, or one of, I think, the largest property company. And the way they make their money is they own all of their restaurants, and they charge a percentage of sales for the rent. So McDonald's won't work for me, but there are other chains like Burger King, Wendy's, Taco Bell, Popeyes, or a number of other chains where actually the landlords are not those companies. They're independent real estate owners, and they rent them out. So now I have a situation where I found a location through my friend that he owns. He's been successful for 20 years. And the idea is, why don't we look at, because they're not able to make the rent payments, instead of giving them a rent concession, maybe it's in our best interest to maybe ask them to leave and to put another business in there where instead of someone else making the money, we make the money. Now, obviously, to get a yes decision out of this, I have to convince my friend with numbers. I also have to convince myself with numbers, because the last thing that I want to do is to get into a business where it doesn't make any sense. So the idea is, in corporate finance, one of the things that we need to become very attuned to is how to negotiate out of these financial difficulties. So a lot of times we want to look at tools to say, okay, well, is there an opportunity? Now, it's interesting, if you look back at a lot of the previous recessions, from the Great Depression to the most recent recession, a lot of businesses are born or start during these challenging times. There's a surge in applications for people to collect unemployment. And then what happens is there's a lot of people that says, I don't want to work for someone, now I've just got to work for myself. So this is the time you'll find a lot of opportunities. Other people will give up and be desperate and just want their, maybe government assistance, and maybe are not so inclined to take on an entrepreneurial choice. And some firms have an entrepreneurial spirit where now there'll be a time to say, oh, let's do something. So if we start off with how we negotiate out of a financial difficulty, the way I like to look at it is there are two aspects. There's the business and the financing. So in the current restaurant that we're talking about, let's say there's a Wendy's there, and we have the sales data. So we know that the revenue is there. Now, as the landlord, I don't know their detailed cost structure because it's a private business and they don't have to give it to me. But I do know they have sound revenue streams in 20 years. The first thing we do when we look at a restructuring scenario is we say, how is the business? Ignore the debt, ignore all the other issues. And if the business is sound, we then focus on how it's owned and financed. Now, if the business is not sound, we go down another avenue. And that avenue would be looking at things like, for example, do we want to offshore? Do we want to find ways to lower the cost? Now, one of the things that we're looking at doing, because in India I have a team of 70 people and we provide back office support for doctors and lawyers in California, one of the things that I'm looking at doing is if I get these fast food chains, if you go through the drive-through, why don't I have it when you place your order, that order goes to one of my staff in India, because the cost structure in India is very different than the cost structure in the United States. So I'm looking at ways that I can, with the infrastructure I have, look at the cash flows. So when we assess a problem, the situation is there an operational problem with the cash flows? Now, in the case of the restaurants that I'm talking about, I don't believe there is much of an operational problem. They are run by a large franchising company. They are a little bit mismanaged. I could probably fine tune them and improve them, but they are sound businesses. The problem that they have is the rental contract was set on a very high rent years ago in a lease, and to be honest, they probably won't renew the lease. So the only thing that we need to change is the cost of the rent, and because we are the landlord and we want to convert it to our business, well, that's very easy to change in the new structure. The other thing when you look at a financial difficulty is the financing. So a lot of times you'll have situations, and this is the case with these companies, these restaurants, is they took on a lot of debt. They took on a lot of private equity debt, and the problem with this debt that they've taken on is it's consuming too much of their cash flows. So the problem that they have is there's too much debt. So the point I'm trying to make, if the business is sound, then you need to focus on fixing the financing. Now, when you fix the financing, someone's going to get hurt. I was speaking, a friend of mine, I'm helping to make some investment decisions, and this kid was saying to his mom, well, I want to, General Motors did really well. And he had picked out some different companies. These were in the cruise line industry. He says, well, at the end of the day, look at General Motors today. The stock is doing reasonably well. I said, hold on. If you go back to General Motors back in 2008, I think General Motors did a 100-for-1 share split. So if you had some shares in General Motors, 100 shares became one. And if you had debt in General Motors, the debt was converted to shares. So what happened with General Motors actually is, just because you own shares doesn't mean your shares made the money. Sometimes the old shareholders, their value disappears. In the case of these fast food chains, they call them QSR, quick service restaurants, is a term in the US, QSR. So in the time of these QSRs, what happened is the owner of that restaurant took on a lot of debt to set up that location, not to own the real estate, but to own the business. But the business doesn't support the debt. So as the landlord, or as from the corporate financing perspective, there are different parties at stake here. There is the landlord who owns the building. There is a current operator, and then there's myself, and I'm working with the landlord. Well, because we can terminate the lease because of the back rent, we don't really need them to stay there. So in analyzing this situation, the current owner of the franchise doesn't have a lot of bargaining power because we don't need them, because we can put another franchise in there. Now, if it was difficult to replace them and we needed them, they had a special skill, then of course, when we do our negotiating, they would have a bit more power. So a lot of times in these negotiating financial difficulties, sometimes you need the current owners to be around and you want to give them a deal. Other times you don't. So other times, the current owners, you could just say goodbye. So when you're looking at these financial difficulties, you got to understand the different parties, what they can bring to the table, and at the end of the day, who has the most power. Generally, the most power are the people that apply to the loans. If you can't make the loan payments, they can go to court and they can force a restructuring. They can force a bankruptcy. So this is an interesting scenario here. So when we look at a financial reconstruction plan, what we generally want to do is look at the position of every party. So right now, I'm seeing an opportunity with my friend. So it's the landlord in this case, it's the current franchisee, and it's the providers of debt to the franchisee. So in this case, the franchisee debt providers who provided loans to that current location don't have much power. So the issue before I came into the picture with my friend was more, well, if the store goes vacant, they were worried about what if I get zero rent versus some rent. So you want to look at the position of every party under the under if you close. Now, if we didn't want to operate, let's say, a Burger King in these locations, we might be very interested to do a deal to get some rent versus no rent. But what we're thinking is, we don't need you. We can make more money if we run the business ourselves. Then the next thing to look at is where the money's going to come from. Now, raising money is difficult. The most common way to raise money is if you have real estate to back loans. If you don't have real estate to back loans, it's very difficult to raise money. And I'll talk about that in a few minutes. We then come up with the new way we want to do business. So here in the Reconstruction scheme, we want to cut out the current operator. Now, in doing this, going back to the operator, let's say the Wendy's, well, I can't go to Wendy's right now and say, give me the franchise because somebody else is there. But the moment that restaurant is going to be evicted because the current landlord doesn't renew the lease, I can probably go to Wendy's and say, hey, I have the building, it's already fitted out, we own it, give me the franchise. And if they say no, my backup plan will be to go to other companies like Burger King's, Five Guys, etc. So in the Reconstruction scheme, I'm trying to assess what are my alternatives. I want to assess the new position. So here, the new position from at least our perspective is my friend can get all of his back rent. And by getting all of his back rent, he's able to then use that money to pay off other debt or to use it for other investments. And the core thing about any reconstruction is the business viable. So again, my perspective here is we have these locations, they've been in there for 20 plus years. We have the sales data for 20 years. We know based on statistics of those sales data that those locations will be very, very viable. So that's kind of the thought process up to there. Now, before I go on to the next slide, if you have any questions, can you type them into the question box?
We have one question, Mike, from Sulaiman. Is it preferred to go ahead with debt financing or equity financing during the business crisis?
That's a very good question, Solomon. Sorry, I can't see the questions here, but that's a very good question. Well, a lot of times it's a matter of what choice do you have. Now, oftentimes we're going to go to debt financing because we have no choice. So let me give you some different scenarios here. In the United States right now, if you have real estate and you have a strong balance sheet and a strong cash flow, you can get 30-year loans at all-time lows. So in that situation, in the United States context, we can get loans that are at ultra low interest rates fixed for 30 years. A large element of debt makes sense. Now, the moment you don't have security, like real estate, to back your loan, the problem when you don't have security is interest rates become very expensive. So you got to be careful, because if I go back to 2008, the last crisis, and I ask you, did interest rates go up or did interest rates go down? It's funny because half the people will say, well, interest rates went down in 2008. And other people say, no, they went up. Well, what actually happened in 2008 is interest rates went both up and down. It depended. The very, very conservative quality loans, interest rates went down. The riskier type of loans, interest rates went up. So the spread between good and risky stuff widened. So what I'd expect to happen in today's environment is if you don't have a sound balance sheet with strong assets, I would expect interest rates to go up. And then you got to be careful, because if interest rates go up, you could be have a very big risk of bankruptcy, because you have to make those debt payments. The advantage of equity, on the other hand, is equity isn't going to force you into bankruptcy. Now, one of the things that I talk about when I do my corporate finance training is gearing. And when we talk about gearing, most people think gearing is financial. And actually, it's a broader perspective. Gearing is the level of your fixed cost. And there are two types of gearing. There's financial gearing and operational gearing. So with financial gearing, it means you have a lot of fixed costs because you have a lot of debts. With operational gearing, it means you have a lot of fixed costs because of your operational structure. So if you take an airline, and most of the airlines, the problem is that their fixed costs from an operational view are very high. So therefore, if you have high operational costs and you couple that with high cost of interest, you have lots of fixed costs, you have a huge risk of bankruptcy. So to answer your question, do you want debt or equity? You got to look at the risk. If you have a lot of fixed costs in your business, like an airline, and you take on a lot of debt, there's a huge chance of bankruptcy. If your business has a lot of variable costs, so your operational costs can go up and down with your volume, you're more in a position to take on debt. So the level of debt, it's a complicated question. If we get it wrong, we could be bankrupt. And if we don't get, so it's not such an easy question. It's not such an easy question to ask. So I hope that's a little bit clear. Were there any other questions there, Mimi? I can't see the questions on my screen.
There is one more. Do we have to change our finance plan, which was already made due to this COVID-19? And how this is going to affect the plan? This is asked by Mr. Mohammed.
Yeah, Mohammed, that's a good question as well. I think one of the problems that I have when I worked in the GCC region a lot is we have this mentality where we prepare a budget for a year and we have this more process where we set our goals in a year in advance and we kind of keep them a little bit fixed. There's a whole technique there called beyond budgeting and a different way to look at things. And what we need to really be doing is being agile, and every time there's new information, we want to adjust. And for a lot of industries, I would presume that with COVID-19, there's going to be a massive amount of adjustment we need to do. For some businesses, it doesn't have an impact. For example, we have a business in India. We provide support services to doctors and lawyers. So for there, I have to revise my business plan because there is more demand, there is more pressure on cost control and to get costs down. I also do training, for example, and training right now, because we can't travel, obviously those costs are going to change. So I think you're going to find with COVID-19, it has an impact on a lot of businesses. And if it impacts your business, of course, you got to revise your plan. I think the biggest mistake in the GCC region, especially, is we do plans too far in advance, and we have this idea of, like, I prepare once a year my budget to ask for my capital expenditure. No, ask for it when you need it. So definitely, I think we need to prepare more and more plans and make changes because it's a very fluid situation. Okay, I'm going to go ahead and proceed. If there's any other questions, keep typing in the box there.
There are some other questions, but I will just read them.
How do I see the questions on my screen? Anyways, okay, I'll continue and I'll ask someone else.
Yes, I'll just read the questions a little bit later, just so we can be in time with the presentation. Thank you.
That's fine. So we get onto the plan. So the question here is, let me ask you a question. So I'm going to open up a poll here. And what I want you to do is to answer your questionnaire. Because as I go into the business, what I need to do is to worry about or to work out the best way for me to make money. So, and obviously my idea would be to open up this restaurant, to get it going, and then I want to sell it. So here's my idea. I take over this franchise, I get in there cheap, I get it going, I get solid cash flows, and then what happens after I get the solid cash flows, when the economy returns around, I sell this, and you can normally sell these restaurants to someone else who operates money chains. So I get in cheap, I restructure it, and I get out. So my question to you is, there are three choices I've given you: a DCF, a relative valuation using multiples, or a payback. What is the best technique for me to value the business? How do I see the questions here? These questions, or I can't see them. I'll give you another. All right. So, anyways, let me close the poll here. Let me see the responses. And the responses are interesting here. Okay, so 56% of the people said I should use a discounted cash flow technique. 36% of the people said I should use a relative valuation or multiples. And 8% of the people said I should use payback. Now, these are all interesting approaches. What is the one that I should use? And I'm going to be talking about that. That is the very thing, because when I'm going into this business, I need to value how I'm going to sell it for. And what I'm going to be going through the next few slides is how to do that. Now, the problem with the discounted cash flow is it requires a significant amount of projections. And it's probably the best valuation technique. However, when you buy businesses like an existing QSR, a quick service restaurant, what you normally find is their values are based on multiples of revenue or multiples of EBITDA, earnings before interest, tax, and depreciation. So in this industry, probably the best answer is a relative valuation. And I'll be going through that in a lot more detail in a few minutes in my presentation here. So let me just continue here with the slideshow. Okay, so the plan. So things I need to look at is obviously my entry cost. So this is a little bit easier because, well, it's a bit interesting because if you go to these large companies, the KFCs and McDonald's and so forth, they have basically, got to close the poll. Just 1 second, I'm trying to close the poll here. Can you close the poll? Okay, great. So, okay. So one of the things I need to work out is what are my entry costs? Now, this is interesting because traditionally when you go to a Burger King, a KFC, a Wendy's or a fast food restaurant, they're going to say, okay, there's a franchise fee of $30,000 to $50,000. There's a fee for the location. There's a fee for the equipment, and there's working capital. Bang it all together, it's about $750,000 per location. Now, the difference here is that we already have a locations. So I'm going to be working on the entry cost, trying to negotiate with whatever franchise I select. The best would be if I could go back to the original company I'm at and say, well, why don't you give it to me? They're evicted. You don't want to lose your royalty. Let me continue. But then getting a franchise is going to involve a lot of, I've got to demonstrate that I have the assets, the experience, the business acumen. So, generally to get these franchise arrangements, you got to prove that you have the financial acumen, the ability to run it. You can't just apply very easily to them. So that's going to be a bit of work. And then for me, the most important thing is, how do I cash out? That's what I'm going to be speaking to. And that's what I'm going to be talking about, the relative valuation. Now, when you analyze it, if I just go on for a second to the next slide here, when you analyze it, there are different ways to analyze this. There's payback, return on capital employed. By the way, I'm going to be going back to the valuation technique. That's a whole few more slides, so I'm not rushing that. I will be onto that a lot more. So when we do the analysis here, the question is, what is the best way for me to assess the risk? There's return on capital employed, there's payback, there's cash flow techniques. So I asked you another question here on the poll, and I'll give you just a couple of minutes. What is the best technique to assess the risk? My question is the risk. I'll just give you not a very long time to deal with that. So a lot of you are saying return on capital employed. Some of you are saying payback. Majority of you saying capital employed. Now this is interesting. And obviously in these webinars, it's difficult to spend a lot of time going through these topics, because I would spend a lot of time on these when I do my in-classroom courses in consulting, going through the real scenarios. So I'm going to close the poll now and just show you those results. So a lot of you said return on capital employed. Now, to assess risk, the problem is, why do we use return on capital employed? Return on capital employed, which most of you thought was the best answer, is telling you your return over your investment. But how does that assess risk? Does it assess risk? It just tells you return versus investments. So that is probably not a good risk technique. If I use the discounted cash flow, which 10% of you said, well, that probably doesn't assess risk so much. See, one of the best risk techniques is called payback. Now you're saying, why is payback a technique to assess risk? Well, what payback is saying is I put money out and how long to get it back. So if I go back to 1995, I flew to Romania. I got a job here with Deloitte, a big, one of the big four firms. And at that time, I was paying $700 a month in rent. One Saturday I came home and I opened up the newspaper and I noticed that the apartment I was living in, I could buy one like it for $15,000. Thinking, hold on, $700 a month rent, they cost $15,000. Now this is back in 1995. Romania went from communism to capitalism. There were no loans here. So you couldn't go to the bank and get a loan to buy real estate. So I said, wait a minute, I've got a contract with Deloitte for 2 years. I could get some money and the rent will pay back my apartment in 2 years. So what I decided to do is to apply for, this is back in 95, so I sent in 30 applications to different credit card companies, and I got a load of credit cards, and I bought 4 apartments for $15,000, $20,000. And all my friends thought, Mike, you're crazy. You bought a property in Romania and you bought it with credit cards. You're nuts. But my logic is as long as I kept them rented for 2 years, I got all my money back. Well, what happened since 1995, prices of property went from $15,000, $20,000 all the way up to $150,000 in the next 10 years. So usually when you assess risk, payback is one of those techniques. So going back to my example here with the Wendy's and the Burger King, I would say, well, how much money do I have to put out? And how long do I have until I get it back? And if I can get it back relatively quick, that's lower risk. If it takes me a long time to get it back, That's a higher risk. So normally when you look at startup businesses in this COVID pandemic type environment, one of the key questions I would ask is, okay, how much money do you need now? And when do I get it back? Because today, cash is king. It might have a wonderful discounted cash flow rate. It might have a great IRR. But if those cash flows are in the future, and it's going to require a lot of cash now, and it takes a long time to get my money back because the payoff is later, that means if things go wrong, the longer it takes to get my money back, the more risky it is because there could be a change of events. And the quicker to get my money back. So when I'm analyzing risk, I'm going to say, okay, one of the things I want to look at is how long to get my money back. Discounted cash flow, return on capital employed don't really tell me a lot about risk and how long to get my money back. Now, the next thing I need to look at is the different sources of financing. And the hardest thing in this environment is going to be to raise money. Money is very difficult now. Money will be tight. Just 1 second, let me close the poll here. Can you close the poll, Mimi? I can't.
It appears that the poll is closed. You just have to shift now to the slides.
I am on the slides.
Okay,
you
perfect.
see the slides now?
Yes, we do see the slides now.
Okay, great. So raising money in this environment is tough. It's tough. As the expression that you'll always hear is cash is king. So now is the time to save money. Now is the time not to spend. Now is the time when you'll probably find salaries are going to be cut. People's incomes will be going down, and those that have will be in a very strong position. So when you look at sources of finance, there's kind of a natural chain. Owners, family money is the starting point. So in the case of this business I'm talking about, well, my angle is going to be more so that my friend has property, we can take mortgages against that property. Now, let's say that you don't have that situation. The next thing you move into what are called angels or seed capital. It's the same thing. And generally what you find with angels is they're rich people, like you see the Shark Tank on TV. It's a TV series in the United States with Mark Cuban. Presumably you've heard of Mark Cuban. He owns a sports club as well. But the Shark Tank, those angel investors listen to young people, listen to great ideas, and they throw money at it. Now, the problem with angel or seed money is it's hard to get a lot of money that way. They generally throw money at smaller things. You come up with an idea, they give you some money, they say, okay, it sounds interesting. After that, you move on to bigger money where it's more of a corporate structure. And this is the venture capital. Now, to me, venture capital is very, very dangerous because venture capital are super shrewd. Give you an example there. When this is back in the 90s, and if you just turn the clock back a little bit, this is a true scenario in Poland. I had a friend who was a senior vice president with Bank of America, and he had some other acquaintances who were senior managers at McKinsey. Now, if McKinsey is the Rolls Royce of consultants, if you're in the Saudi Arabia region, McKinsey is the one who provided a lot of consultancy advice to the Crown Prince on a 2030 vision. So they are the Rolls Royce of consultants. So if you had a McKinsey consultant, a senior manager there, and the vice president of Bank of America. They have very strong resumes. So they got some of their own money, and they went together to get some venture capital, and their whole business idea was to open up a bank. Now, why would they want to open up a bank? Back in the 1990s, the concept was internet banking. Telephone banking. This is before internet banking, telephone banking. And their idea was we acquire a lot of customers and we sell, because those banks were valued based on number of customers. So they set up a bank in Poland called Intellego. You can Google it. Now, when they set up Intellego, their whole business model was get a lot of customers and sell. The problem was we had a crisis that hit in the late 90s. And when the crisis hit, well, the problem was they weren't able to satisfy the requirements of venture capital. So what oftentimes happens with venture capital is you borrow money or you raise money with them, but they oftentimes will squeeze out the founders. So the people that made money in that bank were not the founders. It was the venture capital. So for me, when I see venture capital money, I'm extremely scared. I don't trust them, and I want to avoid them if I can. But sometimes you have no choice because that's the only way to get money. So, but to me, that's very, very dangerous. When you get if you don't have any real estate to get loans against and you have to go to the venture capital, there are a lot of these venture capital firms. They look for very high, good returns. They're very risky. When you get a little bit bigger, you can go to banks and there's government programs. Then eventually you can try and get some money like what Facebook did before they went IPO'd. They got some private investors and then you IPO'd. So in my case, with what I'm talking about, I'm probably going to focus on the owner's money and family and friends. Because to raise the kind of money I need for this, if I were to go to angel or venture capital, it'd be very expensive. So going on to your question is, do I want debt? Well, the kind of debt that we might get is with the family and friends who have real estate to back those loans. Because if I can use real estate to back those loans, I could probably get debt for, say, 4%, 3.5%. If I get debt that is not backed by real estate, I could be looking at 10, 11, 12, 13%. It could be very expensive because if there's no assets to back it up, the interest rate skyrockets. When you look at debt, it's a really interesting question. It all depends on what is the arrangement. In some countries, the government, in the United States, we have the SBA, the Small Business Administration, provides a lot of assistance to help companies get government loans or loans the government guarantees at lower rates. And in the United States, if you want to get an SBA loan, they're about 6%. So now the problem for the SBA loan, why I wouldn't qualify, is I haven't ran a fast food restaurant for a number of years, so I don't tick all of those boxes. So I have to find another way around it. Government programs, in a lot of countries, governments really try and encourage businesses to take off, especially in challenging times. Now, I think in the GCC region, the governments are tightening back. We saw in Saudi Arabia that they took the VAT, went from 5 to 15%. They're taking away government assistance. So I'm not sure if the mentality there is the same as the US, but that can be a good source. When you raise debt finance, it's very important to understand the perspective of the lender. Banks don't think like entrepreneurs. The problem with an entrepreneur, I remember my very first cash flows, I did them with the guy Arvin, he's probably on the conference right now. When we did our cash flows for our initial business in India, or our outsourcing business, we would be the next billionaire in the next 7 years. So a lot of entrepreneurs, when they do their initial cash flows, they are ridiculously optimistic, revenues skyrocket, costs go to zero, and there's huge profits. And so most banks know that entrepreneurs, especially younger ones who haven't been around that much, their optimism is a bit risky. So banks are very, very conservative. And when you go to a bank for a loan, they have a way that they look at it, which is not how an entrepreneur looks at it. I told you about my idea when I bought my property in Romania. Now, if I told a banker, I'm going to buy real estate on credit cards, or if I told a typical person, I'm going to buy apartments on credit cards, the typical person would say, Mike, you're nuts. you don't buy an apartment on credit cards. And generally they're correct. But in my case, it was different. I bought an apartment, let's say for $20,000, and the credit card interest in the US at that time was 10, 11%. I was able to use my salary from Deloitte to help make payments, and the income from the property paid back the loan in 2 years. That was an unusual situation. That was an expensive type of financing because it was my only choice. So a banker would say, there's no way we're going to give you a credit card to buy real estate. So the problem is when you're an entrepreneur, a business person, what might sound logical to you, as you go to a provider of finance, you might find the provider of finance says, I don't agree. And they're very, very fussy. So banks have this thing with a purpose. They want to know why you need the money. Banks like long-term assets to have long-term loans. Banks like short-term assets like working capital to have short-term loans. Banks like to see the matching. How are you going to pay it back? Banks very much focus on the terms to make sure it makes sense. In the 1990s, there was Orange County is a very conservative, wealthy county in California. And what they did, I think this was back in the 90s, is they used to borrow a lot of money. And what they would do is back in the 90s, short-term rates were really low and long-term rates were high. So if the short-term rate is 2% and the long-term rate is 4%, I borrow at 2, I deposit at 4. And Orange County, a very wealthy conservative county in California, borrowed so much money that they made huge profits because they borrowed cheap and they invested expensive. But the problem is short-term rates went up. And because the investments were fixed in long-term products, when the short-term rates exceeded the 4%, they went from making a ton of money to going bankrupt. So banks are very focused on, does it make sense? And they don't look at it like an entrepreneur. So when you come up with your idea for financing, you need to have people that you work with that know how the bankers think. Bankers think different. Entrepreneurs think different. We don't think the same. And that is one of the challenges, because to us, what is logical is not logical to a banker. Let me pause now for a few more questions. Let me see if I can read them even. Mimi, are there any questions now? Because I can't see them.
Yes. So we have a question from Mr. Mashkor. Has investment banking restructured after the global financial crisis of 2020 so that another such crisis would not happen again?
Good question. I believe there's always going to be a crisis. Part of economics, going back from the last 100 years, there's booms and busts. They always try to restructure, something else happens. I mean, a couple of years ago, we never expected COVID. I was speaking, when I was in India 2 months ago, I never in my wildest dreams imagined them closing my office down. So bankers are always trying to restructure, but they're always focusing to make money. So I think they'll always try and make things better, but I think these are cycles that we just cannot get around. The problem we're having right now is in the United States, the government is throwing so much money trying to fix problems that debt has to be paid back. That causes other problems. So in my view, yes, they try to fix problems, but then new problems arises. It's been the whole history of the world. That's just part of the cycle. Any other questions, Mimi? I can't see the questions.
Yes, we have one more from Priya. Do you think impact for COVID will have major impacts for 2020 only? Or how long do you think the impact will be stretched across upcoming years? Can you try to specify on certain sectors like real estate, retail sector?
Yes. So look, we had a pandemic in the Spanish flu in 1918, and things go back to normal. I think humans have somewhat of a short memory. So I think in the short term, there's going to be havoc. For example, travel industries are going to be devastated. Airlines, people won't be flying. Restaurants, there's going to be a period of time where they'll have these social distancing rules. And if you have a restaurant that's, especially in places like London or Dubai, that have expensive real estate, and you're all of a sudden told to space out, that's going to kill your margins. So I think that COVID will have an impact for a few years. We'll get used to it. It'll go away just like the Spanish flu. Industries that will do well and industries that will hurt. Well, I think you're going to find there is what a lot, I was reading the other day, this has been a very, very fast change to technology. So what we've done is we've had people work immediately at home with very, very little warning. So it's fast-tracked some aspects of our economy. So I think those areas of home working and stuff are going to be taken and to new levels. People that don't have skills, the more uneducated, are going to be hurt. So I think, food is going to be strong. You're also going to find there was a lot of concern because a lot of production was done in places like China and other countries that were far from our own country, that I think governments are going to say it's too risky to have these complicated global supply chains. So I'm expecting what COVID is going to do is encourage and force a lot of governments to say, including the GCC region, we want some stuff to be manufactured locally, because what if China closes their borders? Because of course, China has to take care of their own people first. Take masks. I mean, we couldn't get the mask out of China. So I think you're going to find a lot of manufacturing being relocated. Now, manufacturing today is different than a few years ago, because manufacturing now is much more automated. The problem is to move those plants out of China to other countries requires a significant investment. Japan, in their stimulus package, offered a lot of money for companies to move manufacturing from China back to Japan. In the old days, labor was very important, but labor is becoming less important in a lot of manufacturing through automation. So we don't need something to be manufactured in China in the fact that it's automated. We might as well take that automated plant and put it back in Riyadh, in Jeddah, in Dubai, or in some area that's a little closer. So I think you're going to find huge opportunities where manufacturing is going to be shifted through political pressure and also through security and supply chain management risk closer to your customers. And that's going to be a huge opportunity. The biggest issue for you in the region, I think, is oil. I don't know what's going to happen to oil. It's very difficult to predict, but you'll find those companies that are agile and open and look at other opportunities. There's still a lot of people in the Saudi Arabia region that need goods and services, and you're going to find, I think, a huge opportunity for these production shifts. So where I think there's going to be more of a problem is common sense. The travel industry, the restaurant industry. So it's an opportunity. It's a time of opportunity for some, and it's a time of pain for others. Did I answer your question there?
I believe we can proceed now with the presentation. There are some interesting questions which I will read later on.
Okay, great. So, valuing the exit. Now, there's where I wanted to spend a little bit of time. And my initial question to you, which I probably should have put now actually, is what's the best way? And that's when you said a discounted cash flow. Now, there are three ways to value assets. And on my corporate finance course that we do with Mimi and all over the world, basically, we do a lot of these case studies in class. I have a case study we do with Ferrari, where we go through how Ferrari valued their IPO a few years ago. It was a very interesting one. Ferrari used to be private. They went public, and with Renault and everything. So the basic valuation, or one of them, is an intrinsic valuation. And what is an intrinsic valuation? It's let's get all the cash flows out. And I'll talk about that more in a second. The second valuation is when you have a relative valuation. And a relative valuation when you use ratios, like you say, okay, my business is worth a value, say revenue times 1 or revenue times 1/2. The third one I wanted to talk about for a second is contingent claim valuation. And this valuation here is one that people don't really understand so well, and I really enjoy it, and it's quite complicated to apply. But what you need to do in corporate finance is go to your boss and say, here's the value, here's my assumption, let's do the investments. So one of the big things what is corporate finance? It's helping a boss make a yes or no decision. It's helping our boss make a yes or no decision. So let me give you an example about contingent claim valuation. If you take Procter & Gamble, back in the 1990s, Procter & Gamble went to Romania. Back in Romania in the 1990s, Romania was a very poor country. People bought very basic detergent. When you rode the underground or the metro at that time, people didn't really use deodorant, and there was all these funny smells and stuff. And as people got more and more money, they bought these luxury products. So now, when Procter & Gamble went to Romania in the 1990s, you would probably conclude that Romania wasn't a great investment if you just looked at the current product offering. But what contingent claim valuation is saying is, if we could go into the country first and get our name known, as Romanians get more money, and we could start getting into the luxury products. Today, Romania is a very wealthy country. There are huge houses here. There's lots of expensive cars, a lot of wealthy people, and there's obviously a lot of people that are middle income and lower class as well. But now there's a very large consumer market. So contingent claim valuation is saying, well, I make an investment now, and that investment opens the door for me to do something tomorrow. And you try to value, in addition to your basic discounted cash flow, what is the benefit, because now that you're in Romania and people can buy basic deodorant, when they become more wealthy, they can now buy this expensive deodorant, expensive lotions, expensive creams. That's contingent claim valuation. British Petroleum pioneered this in the 1970s, where a lot of the oil platforms in the offshore were not viable. So what they said is, okay, if we look at the rate of change of technology, if we get these oil leases, which are now that are not viable because oil it's too expensive to drill, eventually one day the cost of exploration will go down. So in my example with the Burger King I'm talking about, probably a contingent claim valuation wouldn't work. If I talk about my property business in Romania, well, when you're looking at the land there that I have, the contingent claim valuation there might work because my property, the value of it depends on, does my neighbor develop, because my neighbor's next to the road. And so with that, you would be saying, well, I buy farmland, but I could convert the farmland to houses if my neighbor builds houses because my neighbor is closer to the highway than me. So that's contingent claim valuation. Now, if I move on to intrinsic valuation, just for a couple of minutes here. So intrinsic valuation is the most basic, but it's very difficult to do. What is it? It's a cash flow. Now, a lot of people have this perception that you can get a precise value, and that's nonsense. These valuations take a lot of work to do, So to get a valuation, you need to say, well, what is the cost? And we have to take a combination of debt and equity, and that's a whole measure of itself. We have to project the cash flows. But what most people don't realize when you do valuations is you don't do a cash flow analysis for every single year. What you're going to be doing is you normally for 5 years, and then you take the last year and you do what's called the terminal value. So the biggest thing with these discounted cash flows is they take a lot of assumptions. So when I did the case with Ferrari, which I do in class with when you come on my courses, we say, okay, well, we've done a detailed cash analysis for 5 years. 5 years from now, how do we expect that business to grow from year 5 to whatever? So the problem with discounted cash flows is they require a lot of detailed spreadsheets, a lot of analysis, and they're not so easy. So if I look at, and again, it's hard to go through these in a lot of detail here, but the advantages of a discounted cash flow is they take out the emotions. At the end of the day, a business is worth what the money says. And they're based on fundamental of the underlying characteristics. Now, if you talk about Warren Buffett's quite a famous investor. And Warren Buffett is what we call a fundamental investor. And what a fundamental investor does is say, let me look at the cash flow. I don't care what the market says. What I care is what cash can we make. So a discounted cash flow is good for people that buy a business. They don't buy a stock like Warren Buffett. They care about the underlying characteristics. You don't care about the market perception because you have a long-term horizon. Now, I asked you if this is a good way for me to value my exits. The answer is no, because for me, my time horizon is relatively short. I want to get in, set up the Burger King, change it from a Wendy's, get it going, get it making some money, and I want to find a buyer. And the discounted cash flow is more a long-term analysis, but it doesn't really look at what prices are today. So the problem with the discounted cash flow technique, it requires tons and tons of inputs, huge spreadsheets, lots of assumptions. It's easy to manipulate. And at the end of the day, you might get a conclusion that the value is much bigger or lower than what the market is today. So for me, in my business scenario, probably a better technique is pricing. What is pricing? Well, pricing is when you use things like multiples. So in the fast food industry, a lot of times like a KFC or a Wendy's or a Five Guys, those kind of places, you'll find their value is based on a multiple of something like revenue or EBITDA. So with my business in India a few years ago, we do back office support for doctors and lawyers. We were looking at buying some offices in the US that provided those services, and then they outsourced to India. And when you buy those businesses, what you find they're small businesses, and the owner puts through tons of expenses because they don't want to pay income tax, and they fudge on their expenses. The only number that is really reliable is revenue. So in a lot of times in those types of valuations, all you care about is revenue. If I'm a small owner, what I'm going to do is put through as many expenses as possible to pay little tax as possible. I do a trip. I'm going to a trip to the Bahamas. It's business. I got to figure out how to cook a hamburger. I mean, people fudge. So the reason why people use multiples is they're easier. The basic multiple is a sales multiple. So let's say that you have a restaurant that does $3 million a year in sales. You might say that if you do $3 million a year in sales, it's worth $1.5 million. 50 cents per every dollar of revenue. Or another multiple is a multiple to EBITDA. So the thing about multiples is they're easy to get transactions from the market because other businesses have done sales. And you would probably find in the fast food business, if I want to sell, so I get the Burger King set up, it gets going, the economy gets back to normal, I would probably be able to find a buyer. And most people in this sector are going to probably say, okay, we'll pay you 5 or 6 times EBITDA. That's probably what's going to happen. Where a DCF is kind of complicated, and a lot of investors just don't have the financial smarts to look at a DCF. That kind of happens there. With my India business, that was interesting. A few years ago, we were approached. Someone was trying to buy lots of companies like ourselves because they trade for EBITDA multiples of about 5. And what you can do is take a lot of these companies that trade for multiples of 5, you get it to a large enough company and you go on the US, the NASDAQ, once you're on the stock exchange, the multiples go from 5 to say 15 or 20. So one way to realize a huge value gain is to take a company from private to public. Anyways, going back to my scenario, you would probably find that multiples would be how I value my exit. Either multiples to sales, because there's a lot of data out there about different restaurants that have sold and they've sold to what multiples, or sometimes EBITDA. So the advantage of relative valuation, that is the market mood. If the market is overvalued, I get a good price. If the market is undervalued, I get a bad price. But that's what the market is today. Just like with stocks, we use the common thing, we use what are called price earnings ratios. The disadvantage of relative valuation is it might be overvalued. Everything is overvalued. You buy something overvalued. Back in the 1990s, we had these .com, the internet stocks, and they all had huge values. And at that time, they were valued based on revenue multiples. And the multiples were crazy. The largest, I mean, maybe a lot of you on this webinar are a little bit young, but before Gmail, before Yahoo, there was something called AOL, American Online. And everybody had American Online. And American Online had such a big valuation, it bought a company called Time Warner. Today, if you get an email and it's an AOL email, you know that that person is probably 60 years old or 70 years old, and they probably don't have a clue about computers. So, but AOL had a very huge valuation because everything in that era had huge value. So relative valuations simply tell you that based on other things, that's a good price. But if everything is priced stupidly or ridiculously high, so will you. So let me open up to some more questions there. I can see the questions finally, Mimi. Thanks, Ioana. Any questions you want me to go through, Mimi?
Yes, so there is one question from Brian. Do you think if 2021 will be the right year to invest, what would the factors to be considered before investing?
Brian, that's an excellent question. It depends on what it's in. If you go back to 2008, if you're talking about stocks, the stock market bottomed out 3 or 4 months after the end of 2008. And a lot of questions I get right now, if you're talking about the stock market, say the US stock market, the Dow Jones is at 22,000. It went down to 18. I think there's a lot of investment opportunities now, definitely. The factors to consider is understand the business risk, and understand the cash flows. There's going to be a lot of companies now that don't have money. Personally, I would not touch an airline. I would not touch a cruise company. But you're going to find if you have enough money, you could buy an entire cruise ship. You'll probably find very cheap cruise ships to buy. Now, you're going to probably have to wait a few years before people want to get back on those cruise ships. So usually you find in this time in 2008, 2009, there were good deals. They require a lot of analysis. So there'd be tons of opportunities, but the key thing is the analysis. And I think when I worked in the region in Saudi Arabia, what I noticed a lot, especially with the banking sector, is sometimes the analysis that banks would do is a little bit superficial. So now when we're making investments, we've got to go a little bit deeper. You've got a lot of moving parts. So if you're talking about globally, it's different than the GCC region. The GCC region, I'm really concerned about oil. I don't know how it's going to recover. I think there's a lot more risk there. I think the idea of diversifying the economy, it's great. They need to try and do it, but I don't think it's going to be so easy. Any other questions there, Mimi?
There is a question from Saleh. Do you think petrochemical sector has advantage in this period?
Well, if you're a company like SABIC, who takes the ingredients and makes the products, this is a tough question because I think we're going to find, I mean, there's obviously a glut of oil, but the question about petrochemicals is not the same as oil, because where the petrochemicals are being made. So the advantage is if you have a low cost, there could be opportunities there. That's a very difficult. It depends on what customers, what arrangements you have. It's so hard to predict these things. I think the petroleum. Go ahead.
I have another question, but if you have anything else to add.
Go ahead.
It's from Mr. Rashid. Is it an opportunity to open a new business post-COVID-19? What type of
Rashid,
business would you suggest to invest with guaranteed high profit?
okay, when it comes to guarantees, I can guarantee you two things: death and taxes. Besides that, nothing's a guarantee. But this is the definitely time to invest. There'll be opportunities. There'll be landlords with empty premises. There'll be opportunities to get good deals. A lot of businesses start in recessions. So you can do some research on the internet. This is an excellent time to start a business. What? Well, I mean, take Zoom, for example. They boom. This is the conference where people chat to their friends. So what type of business? I would go back to is, well, what skill sets do you have? What geographical region do you have? I think the pandemic, what's going to happen is in countries like, let's take India, for example, where there isn't a safety net, or Saudi Arabia, where they've taken away the payments to the lower income people, there's going to be a bit more disruption. In countries in Europe and the US, the governments are throwing money to help stimulate the economy. So there is definitely a lot of opportunity now. It's very difficult to say what is the best thing. I mean, I found an opportunity because I found a restaurant that's a Wendy's that I can kick out the current tenant. I can convert it. They have a track record there. I have the right entry costs. They have financial problems. So it's not such an easy question to give a black and white answer. There will be a lot of opportunities, definitely. Definitely.
We have another more question from Mr. Saud. It's a little bit more specific about specific industry. What are the risks and advantages of pharmaceutical companies in this pandemic?
Well, pharmaceutical companies is an interesting area, Saud, because the way it works in the United States, it's kind of like gambling. They spend a lot of money on research and they hope they discover a pill or a vaccine or a cure, and they make a ton of money. The issue that I have with vaccines or pharmaceutical companies is in a lot of countries around the world that they want to copy those drugs cheaper. Pharmaceutical is a very interesting industry. I think the way it's driven off the US, because in the US, the patents are quite strong and the pharmaceutical companies are able to get really high prices because of our medical system. The risk of pharmaceutical is there's a chance because of this pandemic that the US could move to more of a socialized type medical approach. And if so, they would then dictate prices, and the prices they dictate wouldn't give the profit margins there that would support the research. So I think if we get a democratic type government in the United States and as a move to more socialized medicine, you'll find that the high margins that they extract will disappear. Of a cousin who's on a cancer treatment in the US, and I don't think the treatment is even available in Europe, and it's $10,000 a month for some of these drugs. Now, the reason why they charge so much is they spend millions of dollars on research. They're able to get people in the States that are able to pay ridiculous prices for medicine to recover the research and make a profit, and then they can sell other parts of the world. A lot of these medical treatments don't even exist in places like India because they're expensive. I'm on an asthma medicine. There's two types of asthma medicine. I don't take it anymore, but there's one of them you take 2 times a day, and there's a round purple one you can take once a day. Now that the one you can take 2 times a day, you can get it for say $20 or $15. It's quite cheap. But the one you take once a day in the United States was $300 because a lot of people don't want to take it twice a day because they forget. And that particular medicine that's available in the US for once a day, you can buy it in Europe, but you cannot buy it in India. So medical makes me nervous because there is these rumblings of socialism in the United States, or these rumblings of trying to get healthcare costs down. You get healthcare costs down, and then what you're going to do is take away the reward that those healthcare companies make. So I think that could be quite challenging, actually.
There is one more question. Mr. Ejas, he's asking for an advice from you. He says, I had a plan to invest in real estate to buy an apartment in India. I have paid token amount before COVID-19 lockdown started. What should I do post COVID-19? Is it good idea to go ahead or withdraw the plan?
I have a lot of opinions about Indian real estate, and I'll tell you my personal opinion. The problem with India is the real estate prices don't make sense. So you can get a house in India, for example, a house that we rented a few years ago, we were paying, I think, $1,000 a month. We were paying $1,000 a month rent for a house that was worth $1 million. So you're paying $12,000 a year for $1 million house. That's a 1% rental return. So if you take the prices of India, the prices the rent versus what the property is worth is out of whack. And the reason why it's out of whack in India is the real estate market is controlled by these big developers. There's loads of empty places they have in Bombay and Pune. And what they real estate developers, I know in Pune, I should say, that's where I have my house. And they put them on the market very slowly to control prices. There's been a few articles recently, and I believe that the economic crisis in India, you're going to find a lot of real estate where those developers will try to hold back and not sell, but there'll be individuals who'll need money. Remember, India doesn't have a safety net for middle-class workers like the US and Europe. So my opinion, if you didn't put a very large deposit down, would be to walk away and wait until there's a killer deal. I don't think Indian real estate is a great investment for apartments. Having said that, when you look at commercial property, the rental returns in Pune are 6-7%. The commercial property makes sense. The reason why you buy a house in India is not because it's an investment, it's because you want to have a place you live in. I think a residential house in India, I know historically the prices have skyrocketed, but I'm expecting prices to really collapse. And I would not, I'm looking to buy something in India with my business partner there, and I'm waiting for prices to hopefully go down the next 2 years. In 2008, when the crisis hit, there was a big lag period. It took about 3 years for US property prices to collapse. They collapsed in 2011. So right now it's 2020. I imagine we'll see the prices start to really weaken in, say, 2022. It's going to take a few years. People can't make their mortgage payments. They start to sell their houses, etc. So my view is, depending upon the deposit you put down, and also look at the rental income to the value of the property, my instinct would be probably to walk away. Next question.
I believe we can proceed now. I'll read the rest of the questions a little bit later.
Yeah, I'm almost done. I've got just one more wrap-up slide. So if any more questions, we can do them now.
Okay, we have one question from Muhammad. I have savings around $10,000. Can you advise if I should keep the savings in the bank or should I invest it somewhere? Please advise the type of business.
Well, if you want to invest in stocks, and if you have a long-term horizon, there are a lot of good stocks to invest in. If you have $10,000 and you need the money to support your family as backup, then no. I mean, in 2008, the Dow Jones went down to 8,000. Before COVID, it was at 30 or 29. And the Dow Jones now is at 22. Before COVID, it was about 29. So I think stocks long-term, the key thing about stocks is to diversify. 10,000 is not a lot of money. So the questions I would need to understand more is, if it is more of a backup emergency reserve, you want to be careful and not lock it away long-term. There are opportunities out there, definitely. I would be very careful about Indian property if you're Indian, because I think there's going to be some deals. In the UAE, what happened last time is prices collapsed. In the UAE, I think property prices have a high chance of going down because a lot of people in the UAE are not resident. They live there from abroad. So if a lot of those people during the recession move out, there could be a very big impact. There could be some good deals. It's very difficult. When you want investment advice, you've got to look at your own personal situation. You've got to look at your own circumstances. And you've got to be very, very careful. The next question here is, yeah, please type them, Mimi. The next question here is the impact of SMEs during a hard time. They make a good percentage of GDP in countries like Canada and South Korea. It depends. My business in India right now, we're very busy because we provide essential services to doctors and we provide essential services to lawyers that deal with work injuries. And those injuries are still happening. So, and I have another friend in India. What does he do? He does recruitment, HR recruitment. He gets a percentage of people's salary. Recruitment is dead. So you can't say what is the impact on SMEs. You got to look at the sectors. So, I mean, some sectors are going to be decimated. I'm so glad I don't have a sit-down restaurant right now. If you have a sit-down restaurant, I think there's going to be a period of time where people do not want to go back to have dinner at a restaurant and sit down. And I think what will happen is the government will say, when you go back to the restaurants, we want the tables further apart. So the SME sector, some businesses are booming and some businesses are struggling. So sector-wise, what I would be saying is, do I provide a service? For example, I was speaking to people who work in the IT sector, who work in things to help people work from home, technology platforms to help the supply chains and so forth. That stuff is booming. That stuff is booming. You know, people that work in old industries, travel industries, hotel industries, I think they're going to be finished they're going to be struggling. Now, said that, you might find an excellent opportunity to find some hotels that go bankrupt in this next period. There'll be empty rooms for a while. Maybe you could convert those to apartments, rent them out, and convert them back to hotels when things turn around. So I think, and you mentioned Canada here, Ahmed. Well, Canada and South Korea and the US have huge stimulus packages. They have packages to support the workers, which they don't really have in all regions of the world. So in those countries, I'm a lot more comfortable. It's just, what is the industry? It's all about the industry. It's not about the SME sector. A large company, if you're a large company and you're a hospital, you're probably, well, hospitals are having trouble because they had to close down from their profitable surgeries in the US to be ready for COVID. So hospitals have this issue in the States where a lot of them are facing bankruptcy because they weren't able to do their normal profitable business. They had to be on standby for these emergencies. It's all the sectors. Now, if I was in a place like India, I would be a little bit more nervous because in India, there is very little government support. The government support they're talking about there, I know they came out with a package in the last couple of days. My concern in India is the support there needs to be to feed people that are really poor. But for people on this phone call, I doubt you're in that category. You're probably in a category where you're middle class, and I don't think you're going to find much government support there. So it depends on the industry you're in. So now is the time to think, to plan, and to find good investments. A lot of people go into their own business when we have these recessions. A lot of businesses are born. It just takes a lot of planning. Mimi, what's the next question?
We have a good question from Mr. Muaz. Do you think we have already hit the bottom, or is it going to be worse in the next months?
So about hitting the bottom, that's a very interesting question. It depends where we're talking. I think the United States, because there is so much stimulus package being thrown around, we've hit the bottom. If I take India, I'd say we haven't hit the bottom because there's too much optimism in India, because in India, you don't have the stimulus package. If you take Saudi Arabia, I think they made some fundamental mistakes because they increased the VAT from 5 to 15%, and they also took away the social benefits. A basic economic thing that we believe in the United States is when there is an economic hard time, the last thing you do is increase taxes. And so it depends where you are in the region. Gold gym went into bankruptcy as well, someone was saying. What is the cause of the future gym business in the GCC? That's another good question there. Well, it's the rich, the people that have money will still have money. For example, in the United States, there's a boom in airline business. You're saying, what? Airline business, a boom? Yes. There's a boom in corporate jet travel, private rich people, because if I'm rich now, I don't want to get on a plane in first class and be exposed to COVID. I want to fly my own private jet, or I want to have a private jet that's rented for me and my family, that we get on it sanitized. I think the gym business is an interesting question someone's asking. If people have money, they're going to still go to the gym. If people, it all depends on the demographic. If it's a gym that's focused on lower income people whose salaries and stuff are being cut, it's going to struggle. So the gym business and the GCC, you know, I think the gyms are expensive if I take Dubai. And I think a lot of people in Dubai, I have friends in Dubai where they've been cut from 5 days a week to 3 days a week. Well, you're cut to 3 days a week, and you have health care, you have school kids fees to pay and stuff. You might find a lot of those people say, I'm not going to go to the gym. So the question there is really, what is the demographics of things? Rich people still want their stuff. If you were in the private jet business now, you could probably do really well because rich people are going to say, if I'm going to go to Europe, I'll go in a private jet so I can't be exposed. I'm not going to go in a first class plane with Emirates in my little room that they closed because I have to go to an airport with public people around. So there'll be loads and loads of things like that. Go ahead, Mimi.
There is another question from Mr. Khaled. Do you expect a devaluation of currency in Kuwait due to oil prices fall? Hence, demand has significantly fallen and business will take time to return back to normal.
All right, if you take the GCC, if we take Kuwait, if we take Qatar for a second, those two countries have so much reserves that the oil price, I mean, they have enough reserves to live on in Abu Dhabi as well, where the price of oil is just dependent upon how much they're going to make them richer in the future. So for those countries, I don't really see why those currencies should devalue. Now, if you talk about Saudi Arabia, that's different because Saudi Arabia is a large population. They don't have the same capital reserves per person as the other countries. So I think Kuwait, you have so much money that I don't expect the currency to devalue because there's so much money behind the government there. Saudi Arabia is a different scenario. Abu Dhabi, the UAE, they have also a lot of money, but that money is more in the Abu Dhabi as well as the whole country. So I'm not sure about that. I think Saudi Arabia is the one that's more risky because it's a more country that has a lot of different industries and so forth. And the other question is the effect of COVID on real estate. I think I already spoke about that. I think real estate prices are going to collapse in a lot of places. I think the UAE, this is not the time to buy. You wait a few years, prices will go down. Saudi Arabia, I have the same feeling. The United States, the same feeling. India, the same feeling. I think that my personal view is that we'll be a buyer's market. And if you want to buy a house for you and your family, save, save, save. Wait about a year and a half from now and look for a good deal. Islamic financing is another question. Does Islamic banking really help in country financing arrangements in terms of different? True Islamic financing is all about risk sharing. And if we had true Islamic financing, which was genuine risk sharing, that would be great. I'm not sure if how these products are currently structured generally are risk sharing arrangements. So if you had proper Islamic risk sharing products where banks said, I'm going to invest in your business and generally share risk for you, that would be an excellent way to take the GCC forward. But if they're not genuine risk sharing contracts, then I'm not so sure. Another question here is how important is for corporate finance to have a deep understanding of strategy? Very much, very much. When you do corporate finance, if you don't understand the business, you don't understand the risk. If you don't understand the risk, you make bad decisions. I mean, there's a case I was talking about earlier this week with another bank, and someone was approaching the bank for a loan to build a factory to build pipes. It was a pipe factory. This is in Pakistan. This is a true scenario. And the problem is if you build a factory to build pipes, there's competitors. And what they failed to recognize is those competitors who built pipes would lower the price on pipes. But the way they made their money was not on the pipes. They would then sell the accessories, the elbows and the turns. And if you don't make all the accessories, the problem is, if you don't understand the business, yeah, we just make pipes, there's a good price. Hold on, you just make pipes, what happens? The price of the pipes collapses, but the price of the things that go with the pipes goes up. You don't make the things that go with the pipes, and you're in trouble. So someone who's good in corporate finance definitely should understand the business. I remember my very first job in South Africa was a chicken farm. I thought chicken farm's easy. Well, I got a tour of the chicken farm by someone in finance. They knew every process along the way. So someone who's good in corporate finance needs to understand that business, I think, to help make the risk assessment. Another question is, in such conditions like COVID-19 and others, what sort of risk levels can be considered for someone to take? Well, risk is an interesting question. If you spoke to my mom and I said, Mom, let's buy some property, my mom would say, okay, we're going to pay all cash, we want no loans. My mom is 80 years old, and my mom's perspective is, it doesn't make sense for me at my age to take on risk. If you spoke about Mike when I was 20, I would say, hey, great deal, prices are low, I'll put 5% down, I'll take on lots of debt. So the risk depends on where you are in your life, where you are in your financial situation, and everybody has a different risk appetite. That's a very complicated question. I'm much more risky than my mom. My dad is more risky than my mom. My mom is very conservative, but my mom, you know, also because of her age. When you're in your 80s, you just want to go to the gym, go running, do your walks, do your hiking, do your skiing and stuff. You don't really want to lose what you have. Another question is, will the increase in VAT affect the stock market? I think so. I personally think the increase in VAT was a mistake. I think you want to increase the VAT, but not when the economy is having all these challenges. I think there'll be pressure from the World Bank and leading economists to maybe rescind that decision. Yeah, I personally think it was a mistake in most people in finance. Finance 101, don't increase taxes when you're in an economic crisis. I mean, I like Trump's policies generally, but the mistake that Donald Trump did is he decreased taxes when we were booming. The Trump tax plan of a couple of years ago should be done today. He did it a little bit early. Car trading business, do you expect? Yeah, well, cars, incomes will go down. People on the phone be able to afford cars too. Outsourcing. Outsourcing is an interesting question because that's my business. So someone's asking me in terms of cost savings and downsizing, is it better to outsource some of the departments? What are the advantages? Well, the problem when you outsource is you lose control. But the advantage of when you outsource, you get an expert in it. So like my business in India, we do stuff at 1/3 of the cost that is done in the US. So there's a cost advantage. On top of that, because we don't have all the labor laws like we have in the US, we have more skilled staff. So for the low minimum wage people in the States that we compete with, our India staff have higher skills. If I was in Saudi Arabia, I would probably want to outsource stuff to Egypt because Egypt, there is significant skilled people there at a lower cost base. However, the government doesn't want you to do that. So, I mean, when I looked at Mobile and some of the phone companies, they wanted to outsource to Egypt, and they had pressure to take it back to save jobs locally, but they were quasi-government companies. So I think outsourcing, if it's done right, because that's my business, but if it's done wrong, it's a mess. In the GCC region, a lot of stuff could be outsourced to Egypt, where Egyptians have a very good work ethic. There's a lot of quality there. Probably the same you can do with Jordan as well. I think, yes, outsourcing definitely. Is it time appropriate in this crisis for margin financing for the purposes of trading? Well, it all depends. I mean, it depends what it is, what you're trading and what it is. You can't talk generally. Everything needs to be specific. Oman is another question about, in terms of Oman, well, Oman is more like Saudi Arabia. It's a country that's not rich in oil. They have to do different things. So I would expect the Oman currency to have a devaluation like Saudi Arabia. They're currently pegged to the dollar. I'm not sure how long that peg is going to last. But yeah, I would expect those countries to go down. There's another question from Abdul which says, will the post-COVID-19 be similar to the Great Depression of 1930? The difference between 1930 and today, from the US point of view, is the United States is pumping money in, stimulus. In the Great Depression in the 1930s, at that point in time, the political decision was, let's wait and let the economy take care of itself. So to me, it's extremely different than the 1930s in the United States, in Europe, because those governments are actively involved. Now, Saudi Arabia is doing what the United States did in the Great Depression. They're increasing taxes, they're taking benefits away. So Saudi Arabia is following the same mistakes the US did in our Great Depression. So the Great Depression, is it similar? Maybe with what Saudi's doing, but I don't think it's similar for the US and the European. So if I just go back and continue here, so when you talk about valuation, so the most important aspect of corporate finance is to say, get a number. What is the business worth? And there's a few myths. Valuation is objective. There's a true value. Nonsense. All valuations are biased. If I'm going to value a business, you ask me who's paying me. You know, the question is in what direction. So there is no such thing as true value. Myth 2, a good value provides a precise estimate of value. No, there are no precise valuations. Now, what's easy to value? The easiest thing for me to value right now is Coca-Cola. I can go to the New York Stock Exchange, type in the symbol, I think it's KO, and that's the price of Coke. The most difficult things to value are the ones where you have the highest opportunities to make rewards. The land in Romania I have land in Romania where their land that is sometimes 1 or 2 meters in width by 1,000 in length. It's a row of corn. Why would I buy that? Well, you can buy that row of corn and the rows of corn next to it, and you could glue them together. You could change the zone, build houses. But if you just have one row of corn, how do you value that row of corn? It's complicated. But if I can glue it together, I can go from a small value to a large value. So the more subjective the valuation, the more of a nightmare it is. Oftentimes, the bigger the payoff. Myth 3, the more quantitative model, the better the valuation. Well, a lot of people, when they do valuations, they will fool you with loads of numbers. My personal opinion is you want to have a simple model. Simple is better. If you make the model so complicated, the problem is you get a false sense of security in nonsense numbers. So when you come to valuations in corporate finance, it's not like there's a precise value. It's asking questions, it's understanding business risk, it's doing a model, it's going to your board or the people that fund your business and saying, here's why I think it makes sense. And if you're really good at it, and you can pick out the right investment opportunities, you'll be very successful. So what I hope you gained out from this webinar is, obviously it's very difficult in these 2 hours, but in the COVID-19 environment, loads of opportunities. The most important thing is the analysis, looking at the numbers. Young people, if I was Mike Turner in my 20s, the problem is I would probably be too optimistic. The problem that we have right now is a lot of people that are, is it the millennials or the ones after the millennials, they haven't seen a recession since 2008. So the younger people that are 20 now, 10 years ago, you were 10 years old in the last crisis. You didn't really affect it. So you saw all these periods of boom, and you just think, oh my gosh. So things always correct. We have booms and busts. So my suggestion is, there's a lot of opportunity now. Keep positive, but be realistic. When I spoke to a friend in India the other day, and he was telling me how wonderful it's going to be because he does recruitment. I don't believe companies are going to be hiring for the next 6 months, maybe a year. So it's not about trying to be positive or negative. It's trying to say, what's my industry? What do I need to adjust? I think someone like that, they're crazy to stay in recruitment, because I think recruitment for the next year is going to be dead. If you have a travel business, I don't think you're going to find a lot of tourists coming to Dubai for the next 6 months. If you have a hospital business, you might be very busy with different procedures. So it's all about perspective. So anyways, I hope to see you in person on one of my future courses. It's great. I come to the region quite a bit, or at least I have. As I say, the glass is either half full or half empty. It can be a sad time if you choose it to be, or it's a fun time. It's your choice. And my suggestion is make it a fun time. And I really hope you learned something from this. You can also, on my last slide here, you could connect with me on LinkedIn. So if you just type in LinkedIn, Mike Turner, ACCA, CPA, CFA, you'll see me pop up in LinkedIn. If you ever want to ask me a question, you can send me a chat message on LinkedIn. It is an interesting time. Keep positive. It's temporary. Maybe it's going to last another year. A lot of my friends in the States, we believe that this COVID crisis will be over in September 2021. Up until then, we'll have some turbulence. So what? Enjoy it, have fun, and move on. Thank you very much, and I'll hand over to Mimi now.
Thank you very much, Mike, for the wonderful presentation. I hope all participants gained a lot of knowledge from this. They found it quite suitable. There are some questions, but I would advise all attendees to approach Mr. Mike on LinkedIn. As he said, he will be able to assist you further. Also, everyone is more than welcome on our upcoming public sessions on the same topic, which is certificate in financial management. So everyone, just please note that the slides are not shared, but the session has been recorded. So it will be uploaded on our YouTube channel, at least, let's say maybe latest by tomorrow, I would say. I want to thank everyone once again for joining. I want to thank Mike once again. And we're looking forward to many more webinars with you. Hopefully we'll organize more often. Thank you very much, everyone. Have a lovely evening ahead.
Thank you.
Thank you.